Anticipated 30% shift in investment strategies across finance, defense, and healthcare sectors by Q1 2025. Expert predictions on international competitive dynamics and policy outcomes. Overview. As we approach the first quarter of 2025, experts are forecasting a significant 30% shift in investment strategies within the finance, defense, and healthcare sectors. This transformation is anticipated to stem from evolving investor preferences, technological advancements, and regulatory changes that characterize the contemporary economic landscape. The implications of this shift are profound, impacting international competitive dynamics and shaping policy outcomes across these critical sectors. Key trends and insights. 1. Investment management shifts. A report by Deloitte emphasizes the necessity for investment firms to innovate their product offerings, particularly by integrating artificial intelligence (AI) into their sales and distribution frameworks. Firms adept in AI utilization are likely to experience substantial revenue growth, contrasting sharply with those that lag in technological adoption. The finance sector is witnessing a notable transition from traditional mutual funds to lower-cost exchange-traded funds (ETFs). By 2023, ETFs accounted for approximately 25% of open-ended fund assets, with projections indicating a continued dominance in inflows moving forward. 2. Technological integration. Technological advancements, especially in AI, are becoming a cornerstone across finance, defense, and healthcare sectors. Investment firms are increasingly employing AI to enhance decision-making processes, optimize operations, and personalize client interactions. Companies such as Voya and JPMorgan are actively developing AI-driven tools aimed at improving portfolio recommendations and operational efficiencies. The healthcare and defense sectors are also exploring AI applications to boost operational effectiveness. With expectations of enhanced patient outcomes and improved defense capabilities. 3. Regulatory and geopolitical factors. Changes in government policies are poised to significantly influence corporate earnings and stock valuations. Economic indicators such as interest rates and inflation continue to dictate investor sentiment and market movements. Geopolitical tensions, particularly in the defense sector, are prompting companies to reassess their strategies. With many countries increasing defense expenditures and investing in advanced technologies, sectors like cybersecurity are expected to experience a surge in investment. 4. Sector-specific dynamics. The healthcare sector is projected to expand due to an aging population and growing demand for innovative treatments and telemedicine solutions. Investments in biotechnology and pharmaceuticals that focus on advanced healthcare technologies are expected to attract substantial capital. In defense, the shift from traditional military expenditures to cybersecurity and advanced technological solutions is anticipated to reshape investment strategies, driven by escalating geopolitical risks. 5. Market performance and predictions. Experts predict moderate GDP growth alongside manageable inflation through 2025, with major stock indices including the S&P 500 reflecting a gradual recovery. However, concerns remain regarding potential market volatility stemming from geopolitical risks and regulatory shifts. The expected transformation in investment strategies is likely to foster increased competition and consolidation within sectors as firms strive to enhance their market positions. Timeline of events. 2023 marked a significant shift in investment flows from traditional mutual funds to ETFs. 2024, firms began aggressively integrating AI technologies, leading to operational efficiencies and improved client engagement. Q1 2025, the anticipated realization of a 30% shift in investment strategies across key sectors influenced by ongoing technological, regulatory, and geopolitical developments. Comparative analysis of different sources. While Deloitte underscores the transformative impact of AI and technological innovation on investment management, other sources emphasize the broader economic indicators and geopolitical factors that could influence market performance. Nonetheless, there is a consensus across various analyses regarding the shift towards low-cost investment vehicles and the projected sector performance dynamics. Conclusion: the anticipated shift in investment strategies by Q1 2025 illustrates a confluence of technological innovation, regulatory adaptations, and evolving market dynamics. As firms across the finance, defense, and healthcare sectors prepare for these changes, the ability to adapt and leverage new technologies will be paramount in maintaining competitive advantage and driving future growth. The convergence of these factors not only shapes market landscapes but also has significant implications for international competitive dynamics and policy outcomes moving forward. The anticipated 30% shift in investment strategies across the finance, defense, and healthcare sectors by Q1 2025 presents several counterintuitive insights that challenge conventional wisdom in these industries. These insights emerge from the convergence of technological advancements, regulatory changes, and evolving investor preferences. Counterintuitive insights. 1. AI adoption versus traditional management. The expectation that AI will streamline operations and enhance revenue growth is prevalent. However, firms lagging in AI integration may not just fall behind, they could face existential risks as the competitive landscape reshapes. The idea that traditional management styles can coexist with rapid technological adoption is increasingly viewed as outdated. 2. Shift from active management to ETFs. It is generally assumed that active management will always prevail in volatile markets. However, the growing preference for low-cost ETFs indicates a paradigm shift where cost efficiency outweighs the perceived benefits of active management. This suggests that investors are prioritizing fee structures over the potential for higher returns, defying the long-held belief that higher fees guarantee better management performance. 3. Healthcare investment dynamics. The healthcare sector is traditionally viewed as resilient, however, the focus is shifting toward companies that leverage technology, such as telemedicine and innovative treatments. This indicates that investors now value adaptability and technological integration over traditional healthcare metrics like patient volume or hospital capacity, challenging the traditional notion of what constitutes a stable investment in healthcare. 4. Geopolitical tensions and defense spending. The prevailing belief is that geopolitical tensions lead to increased defense spending uniformly across traditional sectors. However, firms are also expected to pivot towards cybersecurity and advanced technologies, indicating that the nature of defense spending is evolving. This shift suggests that companies must adapt their strategies to focus on technological defense capabilities rather than merely increasing military hardware. 5. Regulatory changes and market volatility. It's often assumed that regulatory changes will lead to instability. In this case, however, firms that adapt quickly to new regulations, such as those related to ESG and sustainability, may find themselves at a competitive advantage. This suggests that proactive compliance can serve as a catalyst for growth rather than merely a risk management exercise. 6. Mergers and acquisitions trends. The expectation that M&A activity will continuously rise and lead to larger entities dominating the market is being challenged. Current trends indicate a slowdown in M&A activity, suggesting that firms are becoming more cautious and selective, which could lead to a more fragmented industry landscape. This counters the belief that larger firms inherently provide better stability and performance. 7. Investor sentiment and behavioral finance. The assumption that investors make decisions based solely on data and performance metrics is being disrupted by behavioral finance insights. The influence of social factors such as the increasing focus on sustainability and ethical investing suggests that emotional and social considerations are playing a significant role in investment decisions, often overriding traditional metrics of performance. 8. Healthcare technology versus traditional care. While one might assume that the traditional healthcare delivery model would remain dominant, the expectation of significant investment in biotechnology and telemedicine indicates a counterintuitive pivot. Investors are increasingly willing to put their money into technologies that promise innovative solutions even if it means disrupting established paradigms. 9. Market resilience in a low-growth environment. Common wisdom holds that low economic growth leads to market stagnation. However, experts predict that moderate GDP growth coupled with ongoing technological advancement can drive market performance, especially in sectors like healthcare and technology. This suggests that growth can occur even in less than ideal economic conditions, challenging the notion that growth is solely tied to macroeconomic indicators. 10. Risk management perceptions. Traditionally, risk management has been viewed as a back-office function primarily focused on compliance and loss prevention. The emerging perspective indicates that effective risk management is now seen as a strategic asset that can drive competitive advantage. This counterintuitive insight suggests that firms prioritizing risk management as a core business strategy may outperform those that do not. Conclusion. The anticipated 30% shift in investment strategies across key sectors signifies not only a transformation in how investments are approached but also a fundamental re-evaluation of long-held beliefs about investment priorities, risk management, and the role of technology. Recognizing these counterintuitive dynamics will be essential for firms looking to adapt and thrive in the evolving landscape leading up to Q1 2025 and beyond. The report on the anticipated 30% shift in investment strategies across the finance, defense, and healthcare sectors by Q1 2025 presents critical insights that may be overlooked by many readers. Here are some of the significant points that deserve attention and their implications. 1. AI integration and operational efficiency. The importance of artificial intelligence (AI) in transforming investment management is underscored repeatedly throughout the report. While many may focus on the broader economic or geopolitical implications, the nuanced discussion on how firms like Voya and JPMorgan are leveraging AI for operational efficiencies is vital. AI is not merely a tool for analysis but is becoming integral to decision-making processes, client interactions, and operational management. Firms that fail to adopt AI may find themselves at a competitive disadvantage, unable to keep pace with those that do. Significance: the competitive landscape will increasingly reward those who adopt innovative technologies. Companies that lag in AI integration may struggle to attract investors or retain market share in a rapidly evolving industry. 2. Shift from active management to ETFs. The report notes a significant shift from traditional mutual funds to lower-cost exchange-traded funds (ETFs). This trend reflects a broader investor preference for cost-effective, transparent investment options. The reported statistic that ETFs accounted for roughly 25% of open-ended fund assets in 2023 with expectations for continued dominance is crucial. Significance: this shift indicates a fundamental change in how investors interact with financial markets. A deeper understanding of this trend can help financial advisors and investors make more informed decisions, aligning their strategies with evolving market preferences. 3. Geopolitical dynamics and defense spending. The report highlights the growing focus on defense spending in response to geopolitical tensions. For many, the implications of increased spending on areas like cybersecurity may be overshadowed by more immediate economic concerns. However, the projected surge in defense-related investments signifies a shift that could reshape market dynamics and investment strategies significantly. Significance: investors should not overlook the long-term implications of geopolitical risks on market stability and sector growth. A proactive approach to understanding these dynamics can position investors to capitalize on emerging opportunities, particularly in defense and cybersecurity. 4. Regulatory changes and its ripple effects. The anticipated regulatory changes, particularly in sectors such as healthcare and finance, will significantly impact corporate earnings and stock valuations. While many will focus on the immediate effects of these changes, the report suggests a longer-term perspective on how regulations can reshape entire sectors. Significance: regulatory changes often create both risks and opportunities. Investors who can anticipate these shifts and adjust their strategies accordingly may find themselves at an advantage, while those who remain passive may face unexpected challenges. 5. Healthcare sector growth driven by demographics. The report emphasizes the healthcare sector's potential for growth driven by demographic shifts, particularly an aging population. While this insight may seem apparent, the specific mention of innovations in telemedicine and biotechnology as key growth areas is critical. Significance: investors should focus not just on the aging population as a demographic trend, but on how innovations in healthcare delivery and treatment will create new investment opportunities. The intersection of technology and healthcare is likely to be a hotbed for future growth. 6. Market volatility and economic indicators. The report anticipates moderate GDP growth alongside manageable inflation with potential volatility due to geopolitical risks. Many readers may gloss over these economic indicators, but they are foundational for understanding market dynamics. Significance: investors need to pay close attention to these indicators as they can influence market sentiment and investment strategies. Anticipating shifts in economic conditions can enable investors to make timely and informed decisions. 7. Consolidation and competition within sectors. The report discusses the expected increase in competition and consolidation within sectors as firms adapt to shifting strategies. This trend may not be immediately apparent to all investors who might focus more on individual company performance. Significance: understanding the broader market dynamics, including potential mergers and acquisitions, can provide insight into sector health and long-term viability. Investors should monitor these trends to identify potential winners and losers in the evolving landscape. 8. Behavioral finance considerations. The mention of behavioral finance and how investor psychology can impact market trends is often overlooked. The report suggests that recognizing emotional reaction patterns can help investors make more rational decisions. Significance: incorporating behavioral finance insights into investment strategies can lead to better decision-making and risk management. This aspect of investing is crucial for navigating market volatility and emotional decision-making. In conclusion, while the report outlines significant trends and predictions for investment strategies leading up to Q1 2025, it is the nuanced insights, especially regarding technology integration, regulatory changes, and behavioral finance, that warrant deeper exploration. Investors and industry stakeholders should not only focus on the surface-level trends but also consider the underlying dynamics shaping these shifts. Understanding these elements can provide a competitive edge in an increasingly complex and evolving investment landscape. 1. Investment management shifts. The anticipated shift in investment strategies, particularly the transition from traditional mutual funds to low-cost exchange-traded funds (ETFs), signals a significant transformation in how investors approach asset allocation. This shift is attributed to evolving investor preferences for lower expense ratios and the increasing effectiveness of artificial intelligence (AI) in enhancing investment management processes. The integration of AI into sales distribution and operational efficiencies is expected to differentiate successful firms from those that lag behind, potentially leading to substantial revenue growth for those that adapt quickly. 2. Technological integration. The role of technology, especially AI, is paramount across finance, defense, and healthcare sectors. Firms are leveraging AI to optimize operations, enhance decision-making processes, and improve client interactions. The successful implementation of AI-driven tools is not only expected to increase efficiency but also to enhance the quality of services offered to clients. This trend points to a future where firms that effectively utilize AI will gain competitive advantages, especially in sectors like healthcare and defense, where operational effectiveness can directly impact outcomes. 3. Regulatory and geopolitical factors. Changes in government policies and escalating geopolitical tensions are projected to have profound effects on investment strategies. Regulatory reforms such as tax changes and fiscal policies will influence corporate earnings and stock valuations, while geopolitical dynamics, especially in defense investments, are prompting firms to reassess their strategies. The anticipated increase in defense spending and focus on areas like cybersecurity highlights the importance of aligning investment strategies with international competitive dynamics and policy outcomes. 4. Sector-specific dynamics. Each sector, finance, defense, and healthcare, exhibits unique growth drivers and challenges. The healthcare sector is expected to grow due to the aging population and rising demand for innovative treatments, while the defense sector is pivoting toward cybersecurity and advanced technologies in response to geopolitical risks. Understanding these sector-specific dynamics will be crucial for investors looking to capitalize on trends such as the increasing investment in biotechnology and pharmaceuticals, as well as defense technologies, which are anticipated to attract significant investor interest. These 4 points encapsulate the anticipated 30% shift in investment strategies across key sectors, highlighting the convergence of technological innovation, regulatory changes, and evolving market dynamics as critical drivers of future investment landscapes. Here are 3 famous historical cases that illustrate significant shifts in investment strategies and their broader implications on various sectors. 1. The dot-com bubble 1995 to 2000. The late 1990s saw a massive surge in investment in internet-based companies, leading to the dot-com bubble. Fueled by speculation, venture capital, and the novelty of the internet, investors shifted their focus from traditional industries to tech startups, often with little regard for profitability or sustainable business models. The Nasdaq Composite Index peaked in March 2000, reflecting the exuberance of investors. However, the bubble burst in 2000, leading to significant financial losses and a re-evaluation of tech investment strategies. Many companies went bankrupt, and investors learned the importance of due diligence and sustainable business practices. The aftermath reshaped the tech industry landscape and emphasized the need for sound investment strategies, particularly in emerging sectors. 2. The global financial crisis 2007 to 2008. The global financial crisis was precipitated by the collapse of the housing bubble in the United States, leading to a severe recession worldwide. Financial institutions had heavily invested in mortgage-backed securities, which were based on subprime loans. The crisis triggered a significant shift in investment strategies, with a move towards more conservative approaches and increased scrutiny of risk management practices. Governments and central banks intervened with bailouts and monetary stimulus. This crisis highlighted the fragility of financial systems and prompted regulatory changes such as the Dodd-Frank Act in the U.S., which aimed to enhance financial stability. Investors began to prioritize transparency, risk assessment, and the quality of assets, leading to lasting changes in investment behavior across finance, real estate, and beyond. 3. The rise of ESG investing 2010s present. Environmental, social, and governance. ESG investing has gained significant traction over the past decade as investors increasingly seek to align their portfolios with their values. Factors such as climate change, social justice movements, and corporate governance scandals have shifted public consciousness and investment strategies. Institutional investors, asset managers, and retail investors have begun to integrate ESG criteria into their decision-making processes, leading to a substantial reallocation of capital towards sustainable and socially responsible investments. This trend has implications across sectors, particularly in finance, where companies with strong ESG performance are often viewed as more resilient and attractive investments. The anticipated shift in investment strategies towards ESG principles reflects broader societal changes and demonstrates how investor preferences can reshape market dynamics. These cases exemplify how shifts in investment strategies can be influenced by technological advancements, regulatory changes, economic conditions, and evolving societal values, with repercussions that extend beyond the financial sector into broader policy and competitive dynamics. Future outlook: predictions for investment strategies across finance, defense, and healthcare sectors by Q1 2025.
Overview.
By Q1 2025, a significant transformation in investment strategies is anticipated across finance, defense, and healthcare sectors, with experts predicting a 30% shift driven by technological advancements, evolving investor preferences, and regulatory changes. The future landscape is expected to reflect a convergence of artificial intelligence, AI integration, low-cost investment vehicles, and adaptations to geopolitical dynamics.
Key predictions. 1. Investment management evolution. AI integration. Investment firms will increasingly leverage AI for decision-making, operational efficiency, and client engagement. Companies that successfully implement AI tools are expected to outperform those that do not, leading to a significant revenue gap between early adopters and laggards. Shifts towards ETFs. As traditional mutual funds decline, the shift towards exchange-traded funds, ETFs, will continue. By 2025, ETFs are projected to capture the majority of investment inflows, appealing to cost-conscious investors seeking transparency and flexibility. 2. Technological advancement and operational efficiency. AI in healthcare and defense. Both sectors will see increased adoption of AI for operational improvements, enhancing patient outcomes in healthcare and bolstering defense capabilities through predictive analytics and cybersecurity measures. Rising importance of data analytics. Investment firms will prioritize data analytics capabilities to gain insights into market trends and investor behavior, leading to more informed investment decisions. 3. Regulatory changes and geopolitical influences. Impact of fiscal policies. Changes in government fiscal policies, including potential tax reforms and regulatory adjustments, will significantly affect corporate earnings and stock valuations, pushing firms to adapt quickly to maintain competitive edges. Geopolitical tensions. Ongoing geopolitical conflicts will drive increased defense spending, particularly in cybersecurity and advanced technologies, prompting firms to reassess their investment allocations in these areas. 4. Sector-specific dynamics. Healthcare growth. The aging population and demand for innovative treatments will drive investments in biotechnology and telemedicine. Companies focusing on these areas are expected to attract substantial funding. Defense sector focus. Investment strategies will shift towards cybersecurity technologies and advanced military systems, reflecting the geopolitical landscape's volatility and the necessity for nations to safeguard national security. 5. Market performance and economic indicators. Moderate economic growth. Experts predict moderate GDP growth alongside manageable inflation through 2025. Key stock indices, including the S&P 500, are expected to reflect this gradual recovery. Although market volatility may arise from geopolitical tensions. Consolidation and competition. The anticipated investment strategy shift will lead to increased competition and potential consolidation within sectors as firms strive to enhance their market positions. Timeline of events leading to 2025. 2023. Notable shifts in investment from mutual funds to ETFs began. 2024. Firms aggressively integrated AI technologies, enhancing operational efficiencies and client engagement strategies. Q1 2025. A projected realization of a 30% shift in investment strategies across finance, defense, and healthcare sectors, catalyzed by technological, regulatory, and geopolitical developments. Conclusion. The anticipated 30% shift in investment strategies reflects a broader trend towards technological innovation, regulatory adaptation, and changing market dynamics. Firms that embrace AI adapt to geopolitical realities and prioritize cost-effective investment vehicles are positioned to thrive in a rapidly evolving landscape. This transformative period offers both challenges and opportunities, compelling firms to re-evaluate their strategies and embrace emerging technologies to stay competitive.